Well, ladies and gentlemen, let's move forward with our keynote address, for which we have Mr. Amarendra Mohan, who's a Senior Program Director for CAFRAL. Ladies and gentlemen, a big round of applause for Mr. Amarendra Mohan, please.
Excuse me. Okay. Good morning to all of you. First of all, let me thank the Economic Times for giving me this opportunity to share some of the thoughts on Basel III. I know this is a group which is from different sectors, and I'm from banking. And within banking, I belong to the supervisory community. I know here I am in a minority because probably it's one person versus 100 delegates. So 100 delegates from the industry versus one supervisor who will try to explain to you what Basel III is about and like what the Basel Committee tries to achieve through these standards called Basel III. So in the 15 minutes that I have been given, first the disclaimer. The views that I express here are my own and not necessarily that of CAFRAL, where I work, or the RBI, which has sponsored my organization, CAFRAL. So I'll talk about the Basel Committee on Banking Supervision, simplicity, comparability, and risk sensitivity. In a minute, I'll explain what it means. Basel III capital and buffers. And I'm sure some of you from the banking industry would feel that maybe the standards have gone too far. So I'll give you my view or my perspective on that. So this is the building. I don't know if any one of you has been to Basel. So this is a building in Basel, which is responsible for hosting all the standard setters in the world in the financial sector, except for the securities IOSCO, which is based in Madrid, Spain. The rest all, so you take banking, which is the Basel Committee, insurance, which is the Insurance Association, International Association of Insurance Supervisors, EAD is deposit insurance. This is about the payment and settlement systems. Now, the Basel Committee does not have any legal authority to implement or to oversee implementation of Basel III in various jurisdictions. Still, Basel III is implemented in more than 100 countries. I'll come back to this point a little later. If you are in Basel, and Basel is a very small city. I mean, it's something like 200,000 or 300,000 people. And not many of them know that, Basel is known the world over because of the standards that they produce. When we talk of Basel II or Basel III, as those of you from the banking industry might be aware, there are two ways of looking at risk. One is a standard approach or the standardized approach, and the other one is the internal models approach. Now, the internal models are models which the banks use for assessing the risks and also coming up with a capital requirement which the regulators approve. And once they approve those internal models, those models can be used for the regulatory capital purposes as well. if you look at the financial crisis, what happened was that some of these models got so complex that really very few people understood it. And I'm sure the top management, the board of directors of banks, I wonder whether they really understood it or not. Because if they understood, probably they would not have committed their banks to take exposures which turned out to be such a huge loss for the banks. And so the Basel Committee started thinking about it, and what they said was that the risk should be managed by simple means. Not that they're against the models, but then the model shouldn't get so complex that no one really understands except the quants. And it should be comparable across institutions, across jurisdictions. At the same time, it should be risk sensitive. And one of the models, internal models which the banks use for assessing, measuring, and coming up with a regulatory capital number on operational risk this month, that is in March, the Basel Committee said that there, and these are known as the advanced measurement approach. This is known as the advanced measurement approach for operational risk. So the Basel Committee said that there were inherent complexities in these models. There were issues of comparability, and the risk weights were very much varying across different institutions due to differing modeling practices. And so they just said that the Basel Committee proposes to remove the AMA from the regulatory framework. Another development has been that more and more supervisors, and one such example I have given you here, Daniel Tarullo, who is one of the governors in the Federal Reserve. So he says he doesn't trust the internal ratings-based model that the banks use for credit risk. So there is, in the supervisory community and elsewhere, some kind of a mistrust for the internal models. And the authorities, the Basel Committee, is also looking at ways to come up with simpler approaches. Basel III capital requirements. So as you can see here, I don't want to go into the details, but I would just like to highlight one of the key features of Basel III, that it is not just one ratio. So very often you come across, statements like this bank meets Basel III requirements, or this bank doesn't, or that we need so much of capital for Basel III compliance. But please remember that Basel III is not just one ratio. So you have a common equity tier 1 requirement, you have an additional tier 1, a total tier 1 capital requirement, tier 2, and then the total capital requirements. And in addition, there are buffers, conservation buffer, counter-cyclical, and if you are a big bank, a global systemically important bank, or a domestic systemically important bank, then again, these banks are obliged to keep certain buffers. So as I said, Basel III is not just one ratio of 8%, but there are several layers of capital adequacy. And internationally, what is also happening is that not only are people looking at the Basel III numbers, but also they are assessing adequacy of capital, the supervisors, they are assessing adequacy of capital of banks in terms of risk-based capital requirements, which is Basel III, in terms of leverage, and in terms of stress testing. So it's not one ratio that we are talking of here. Well, I have come across comments that, Basel standards are developed market standards, so why should India bother about it? Maybe we could differ some of the Basel capital buffers, because that will lead to some capital savings for the Indian banks, and that banking in India will have to carry higher risk than developed market standards. As a supervisor, my response to that would be that if a bank carries higher risks, it needs to carry higher levels of capital. On the first 2 points, let us have a look at how many countries globally have implemented Basel III. The number is 122. And there are only 27 countries which are member of the Basel Committee, which of course are obliged to implement Basel III. India is one of those members, so there is no way that India can say that the Basel standards are only for the developed markets and not for us. That's not possible, because all our officials from the RBI, they go to Basel, they participate in these meetings, and they're the ones as a group who come up with these standards. So Basel III is relevant not only for the Basel member countries, but also for the other countries, and other countries have implemented these standards. Now the buffers, they provide cushions of safety. Now if we had cars without airbags, they are definitely cheaper. Does that mean that we should not have airbags, or that those airbags are not relevant for the cars? No. There is a cost to the buffers, but that provides an additional layer of safety. Again, these buffers, look at the number of countries that have implemented regulations relating to these buffers. So clearly, I mean, this is something which India cannot afford to miss. This slide shows you, I just thought, just to give you some perspective as to where internationally the banks are going. So this is Switzerland. The banks are, the two big banks are expected to have capital ratios of something like 28%. Sweden of more than, well, the requirement is for one of these banks 21%, but actually they are keeping something like 23% capital. So these are huge amounts of capital. And that leads to the question whether the regulatory agenda has gone too far. So whether the regulators are asking for too much of capital, because there is a cost of capital involved. And let me tell you, I'm also a shareholder in some of the banks. I will not tell you which ones, but, and as an investor, I do have some interests in getting dividends, but then I also feel as a supervisor and maybe as an investor as well, that the bank that I invest in should remain solvent. And not only through the good times, but also during bad times, it should remain solvent and it should give me dividends, even during the bad times. Well, maybe that's not possible with the conservation buffers. So the answer to this question, according to me, is that whenever you undertake some reform, and this is a quote that I have taken from Stefan Ingves, who is the chairman of the Basel Committee, that important regulatory and structural reforms are all too often hindered by myopia. People tend to focus on costs and pains in the short run, leaving aside the longer term gains that the reforms aim to achieve. And that is true of the Basel standards as well. So what they do is they make banks more resilient, more safe, and safe to the extent that the banks can survive the economic and the financial cycles that are there, that will come. The recent financial crisis showed that weak banks can not only create problems for the financial sector, but also for the real sector. And look at some of these figures. So an IMF study which took countries which constituted something like 50% of the world GDP, the total amount of government capitalization, asset purchases and guarantees during the period 2007 to 11 was to the extent of $5 trillion. This is 16% of the GDP of these countries, and on a per citizen basis, it's 5,000 US dollars. So we are talking of huge sums of money here, which the banks, which the authorities, which the government had to put in the banks during the financial crisis. Clearly, the Basel Committee does not want that going forward, this situation should recur. There have been several policy initiatives which have been taken in that regard, and of course, Basel III is one of them. So with this, I thank you for very patient hearing. Thank you very much.
Thank you so much, Mr. Mohan. I request Ms. Sandhya Adal to kindly come forward and present a memento to Mr. Mohan as part of our token of appreciation. Well, that was on the topic Basel III, a new paradigm for managing risk and regulatory capital. Thank you, Mr. Mohan.